Most new investors quit long before they see real results. The first few years often feel pointless, like nothing is happening, and that can be discouraging. But that feeling isn't a flaw. It's the system working exactly as it should. Today, we're going to unpack why the first 3 years of investing can feel so slow, and why that feeling is actually a sign you're on the right path. This video is for anyone who's worried their investments aren't working, who checks their portfolio constantly, or who wonders if all the effort is worth it. By the end, you'll understand the quiet mechanics of wealth building and how to stay disciplined during the early invisible phase of investing. Investing isn't about instant wins. Your money grows exponentially, but compounding needs time to become noticeable. In the first few years, gains are small because your base investment is still growing. A common mistake is expecting visible results immediately, checking weekly and feeling frustrated. The truth is, your consistent contributions are silently building the foundation for larger gains decades down the line. Patience here is not optional. It's essential. Early investing is emotionally challenging. Markets fluctuate, and short-term losses can feel like failure. Many quit during downturns, assuming the system is broken. The reality is that volatility is part of the process. Your portfolio may feel stagnant or even decline temporarily, but those fluctuations are normal and necessary. Long-term growth isn't linear. It's a disciplined, steady path that rewards persistence, not emotion-driven decisions. In the first 3 years, returns are often smaller than expected. That quiet, almost invisible growth can feel like a scam, but it's actually proof that the system is compounding patiently. A common mindset trap is comparing your early portfolio to someone else's who has been investing for decades. Wealth isn't competitive, it's cumulative. Understanding this prevents frustration and keeps your focus on consistent action, not immediate validation. Long-term investing works best when you have a system, automatic contributions, diversified allocations, and disciplined reinvestment of dividends. People often try to time the market or chase hot stocks early on. This impatience undermines growth. By sticking to a simple, repeatable system, your investments quietly compound without constant oversight. Discipline beats intelligence in these early years. The first 3 years of investing are not a scam. They're training. They teach consistency, patience, and emotional resilience. Real wealth is boring at first. The excitement comes decades later, after you've built an invisible engine of compounding that works whether you feel it or not. Shift your mindset from seeking immediate gratification to valuing disciplined, sustainable growth. Consistency beats intensity. Systems beat luck. Time beats short-term judgment. Set up automatic contributions and leave them alone. Even small amounts matter. Ignore daily or weekly portfolio fluctuations. Focus on long-term trends. Remind yourself your wealth is being built quietly, even if it feels invisible. These small steps reinforce patience and discipline, the real drivers of lasting financial growth. The first few years of investing are the hardest, but they are also the most important. If you stay consistent now, you'll thank yourself decades later. Wealth isn't flashy, it's quiet, patient, and compounding. If you want more practical strategies for long-term investing and financial discipline, subscribe to Smart Money Theory. Remember, the journey is slow, but every disciplined step builds your future.